Hey everyone, my name is Olivia Banache, and I will be presenting on the middle portion of Chapter 3. My presentation will cover timing strategy when tax rates change, limitations to timing strategies, and finally, income shifting strategies. So by now, you should have learned about the different timing strategies that affect tax. Let's discuss timing strategies when tax rates change. When tax rates change, the timing strategy requires more consideration because the tax rate costs of income and the tax rate savings from deductions will now vary. The higher the tax rate, the higher the tax saving for the tax deduction. The lower the tax rate, the lower the tax cost for taxable income. Taxpayers should prefer to recognize deductions during high tax rate years and income during low tax rate years. Before any implementations on the timing strategies are made, a taxpayer should consider if their tax rates are likely to change. So, what would cause a taxpayer's marginal rate to change? Well, taxable income can change for reasons such as a new job, retiring, or starting a new business. Marginal tax rates may also change because of tax legislation. Congress frequently enacts tax legislation because lawmakers use taxes to raise revenue, stimulate the economy, and so on. On this slide, you can see some tax legislation laws enacted throughout the years. So there's the American Taxpayer Relief Act of 2012, Protecting Americans from Tax Hikes Act 2015, Tax Cuts and Jobs Act of 2017, and the Bipartisan Budget Act of 2018. Tax laws are always changing. There's currently a new tax proposition, so that's something to always be aware of. So, Exhibit 3-4 presents recommendations for when tax rates are increasing. Accelerating deductions cause them to be recognized in a lower tax rate year. The taxpayer must calculate whether the benefit of accelerating the deduction outweighs the disadvantage. On the other hand, deferring income causes income to be recognized in a higher tax rate year. The taxpayer must calculate whether the benefit of deferring income outweighs the advantage. So let's take a look at Exhibit 3-5, which shows recommendations when tax rates that are decreasing. Taxpayers should accelerate tax deductions into earlier years to reap the tax savings from accelerating deductions to higher tax rate years. Likewise, taxpayers should defer taxable income to later years to enjoy the tax benefits of deferring taxable income to lower tax rate years. So, just a big note, there are limitations to timing strategies. So the following are some inherent limitations. When a taxpayer is unable to accelerate a deduction without also accelerating the cash outflow, the timing strategy will be less beneficial. Tax law generally requires taxpayers to continue their investment in an asset in order to defer income recognition of tax purposes. A deferral strategy may not be optimal if the taxpayer has severe cash flow needs. If continuing the investment will generate a low rate of return compared to other investments, if the current investment would subject the taxpayer to unnecessary risk, and so on. The constructive receipt doctrine, which provides that a taxpayer must recognize income when it is actually or constructively received, also restricts income deferral of cash method taxpayers. So let's talk about some income shifting strategies that affect tax. Tax rates can vary across taxpayers or jurisdictions such as states and countries. That leads to other tax planning strategies such as shifting income from high tax rate taxpayers to low tax rate taxpayers, or shifting deductions from low tax rate taxpayers to high tax rate taxpayers. The taxpayers who benefit most from this shifting strategies are related parties such as family members or businesses and their owners who have varying marginal tax rates and are willing to shift income from the benefit of the group, and taxpayers operating in multiple jurisdictions with different marginal tax rates. One of the most common examples of income shifting is high tax rate parents shifting income to low tax rate children. So, is this really allowed? Yes and no. The assignment of income doctrine requires income to be taxed to the taxpayer who actually earns this. This doctrine means that in order for someone to shift income to another person, that taxpayer must actually earn it. So, for example, if a parent owns a business but wants to shift some income to the child must work for the business. Other ways income can be shifted is by shifting some investment income. The owner of the investment income, however, must be willing to transfer ownership. The IRS closely scrutinizes such related party transactions. Another example of income shifting is transactions between owners and their businesses and limitations. In order to shift income from the corporation to the owner, the corporation must create a tax deduction for itself in the process. Compensation paid to employee owners is the most common method of shifting income. Compensation expense is deductible by the corporation and is generally taxable to the employee. Another way business owners can shift income is by having the business owner rent property to the corporation or loan money to the corporation. Both transactions generate tax deductions for the corporation and income for the shareholders. One thing to note is that paying dividends is not an effective income shifting method. Paying dividends results in double taxation because the profits generating the dividends are taxed first at the corporate level and then the shareholder level. The final method of income shifting I will discuss is income shifting across jurisdictions and limitations. Taxpayers that operate in multiple jurisdictions use income shifting strategies with the proper understanding of differences in tax laws across jurisdictions. Many times, taxpayers may shift income to jurisdictions with a more favorable tax code. There are limitations to income shifting across jurisdictions. The taxing authorities are fully aware of the tax benefits of strategically structuring transactions across tax borders. The IRS closely examines transfer pricing on international transactions. So when taxpayers locate in a low tax rate jurisdiction to, in effect, shift income to a tax advantaged jurisdiction, they may bear implicit tax. Implicit taxes are additional costs attributed to the jurisdiction's tax advantage. So those may be hiring staff, acquiring property, training, etc. So, overall, while reading about this topic, I was surprised to learn that there were many ways taxpayers can strategize to affect the outcome of their taxes. I realized that tax is a puzzle, and the more you learn about it, the more you can use it to your advantage. So, in all, tax is just another puzzle that we must all figure out.